But now it's time to go on to our next panel discussion, which is again a very hot topic, that is of goods and services tax, assessing impact of GST laws on real estate. So let me introduce our eminent panel members for this discussion. Our distinguished moderator for this session is Venkateshwaran, TR, partner, Waterhouse and Company, LLP. He specializes in indirect tax and has over 19 years of post-qualification experience. He has advised clients on tax issues, under-service tax, VAT, customs, SVB proceedings, STPI and SEC laws, along with various due diligence reviews across sectors. He has also advised various multinational companies in matters relating to GST. So welcoming our moderator of the session, I now welcome the speakers of this panel discussion. In an alphabetical order, let me welcome Mr. Achal Chawla, partner, indirect taxes, Ernst & Young LLP. He's focused primarily on verticals of real estate, infrastructure, oil and gas manufacturing, and defense. He has an experience of more than 18 years in indirect tax advisory and consulting, and has assisted various clients in their GST implementation journey across various sectors. Our next eminent panel member, I introduce Ajinkya Gunjan Mishra, partner, SNR Associates, who focuses on indirect tax and trade laws. He advises global and Indian clients on indirect tax in relation to domestic and cross-border acquisitions and an array of complex operational matters, including tax planning strategy, supply chain structuring for products and services, tax assessment, audit, tax restructuring, and compliances. Our next panel member is Mr. Gaurav Dasgupta, partner, real estate and corporate and commercial for Khaitan and Company. He has more than 16 years of experience and a wide range of experience in real estate. Gaurav has also advised on drafting of construction contracts, project finance, EPC contracts, SEC, joint development agreements, infrastructure, and government contracts on various aspects of RERA and real estate investment trusts. Our next expert panel member, let me introduce Mr. Koshal Agarwal, partner, tax and regulatory services, BSNR and Company. He has more than 20 years of experience in indirect taxes, that is GST, trade and customs, FTA, EXIM, and VAT, and has represented clients before policymakers to obtain clarification on the various aspects of indirect taxation. Next panel member, let me introduce Ms. Parveen Mahtani, Chief Legal Officer, Mahindra Lifespace Developers Limited. Her legal work includes regulatory issues dealing in due diligence, contract management, mergers and acquisitions, intellectual property rights, and financial transactions. She is also an independent director of the World Youth Summit, which is a member participant of the United Nations Global Compact and is a member of the International Bar Association. Our next and final member of this session is Mr. Israni, Managing Director, Pacifica Companies, India. He spearheads Indian operations at Pacifica Companies and has been responsible for expanding the group's portfolio across residential, hotels, senior housing, IT parks, townships, commercial and plotted development across Ahmedabad, Vadodara, Chennai, Hyderabad, and Bengaluru and NCR. I now hand it over to our moderator of the session, and this is our expert panel. Mr. Venkateshwaran, I hand it over to you now.
Okay, thanks, Sarna, and a warm welcome to everyone. And first of all, good afternoon, and thanks to Exchange for Media for giving us this opportunity. GST and real estate are very interesting topics, and today I have the wonderful pleasure of moderating a session containing all these eminent speakers. While I have interacted with some of you, it's always a pleasure to come to a common forum and discuss on some of the key things. So before we proceed, I just wanted to set the context on what the sector is all about and what we will cover in these sessions. While I will spend 2-3 minutes giving about the context in which we will be covering, and then I will be asking certain pointed questions to our speakers here, and then we will wind up with their takeaways as to their ask from the government in terms of GST and real estate sector in specific. So with this, I just wanted to start this sessions today by putting a few things. One of it is, of course, the real estate sector as such is one of the, I am being told, and I did a little bit of research on this and told that if it covers retail, housing, commercial, and hospitality put together, it becomes almost the second largest employment generator for our country, next to only to agriculture. And if you see this, if you compare this whole spectrum, this industry was considerably affected due to COVID pandemic. But at the same time, we have seen the changes that are happening over the last few years, and this is making a comeback, and it continues to be a key contributor to the GDP of the country. Having said that, owning a house is a dream and an aspiration for all of us. And it can be owning, or for the Gen Z, as we say, even living in a decent place or exciting place is something which is aspirational for many of us. And that way it plays a very important role emotionally and socially for the majority of the public here. One is the housing part, but when we take on the retail and the commercial part of it, going to a proper office and having an office in a fancy location, or even spending time in office, becomes a very critical part. And now after COVID, we have seen how office spaces are redefining themselves. Commercial places are becoming a rarity today in terms of availability and the price points at which they are making it available. The government is also focusing more on, say, creating economic hubs, as we could see from, they are moving away from special economic zones and trying to focus on economic hubs. So that way, this sector as such is booming in some sense. And I have people from the business here who will talk more about it, but it is more vibrant, maybe the right word to use it. And coming to the hospitality side, India is a tourist destination, right? It has different types of tourism, be it wellness tourism, wildlife tourism, cultural tourism, or even leisure tourism, right? And that way, the focus on tourism sector, as a result, it brings the focus on the hospitality and the infrastructure that is needed to make the tourism a viable opportunity. Once the sector is viable, taxes cannot be far behind. And GST, the focus area of our discussion today, we moved on from having multiplicity of taxes in terms of VAT, excise, buildings and construction cess that was applicable on this particular sector. At one point in time, both VAT and service tax used to apply on the value, and which used to create certain inefficiencies. GST was sort of brought in to make this simple and remove the inefficiencies that was there in this particular sector. Whether it actually removed it or not, we have our panel members who will comment upon that. But my own tidbit says that today, one way to look at it, it's very simple, that you just, from a housing sector perspective, you just levy 5% GST and you're being done with it. But of course, it comes with its own catches. There are no credits allowed. So there is an inbuilt tax that is involved in it. Add to that the stamp duty element to it. Just imagine the quantum of taxes one is paying. And if you add that this entire money is being paid after your post-tax income, which is your savings, on which you already paid your income tax. And over and above that, you pay a stamp duty. So owning a house is it's not only a dream, it's a costly dream. And GST was aimed at making it more tax efficient, but we are not sure whether we have reached there yet. But our panel here will throw some light on it. But I just wanted to be setting this as a context. And in this context, I just wanted to start my questions, and I would probably direct it to Parveen and Rocky to start off the proceedings. See, for the opening of the session, right? I know that COVID impacted this real estate and hospitality sector in a big way. What do you think has been the current situation, and how the industry is coping post-COVID, and whether the indirect tax framework that we have in the country, is it helping it to give it a boost? Maybe Parveen, you can go first. You're on audible. You're on mute. Sapna, is Parveen audible? I can't hear at least. Yeah, very feeble voice.
Now, should I go ahead?
Yeah, please.
Okay, great. So, post-COVID, as we all know, demand for residential has only increased because obviously many are working from home, especially certain sectors like the IT sector. It's still in a hybrid format. What has really worked is the requirement for purchasing a home close to the workspace. People are now willing to live a little further off if they're having a larger space, a lot more green space, so that they have some kind of balanced lifestyle. So we're seeing that definite shift in trend on size of apartments as well as location preference. So residential definitely has gone up in the Indian context because social security, whether pre-COVID or even now, is an issue. Therefore, people in India will want a home because they find it as a reason to have security. Commercial, like I mentioned, we have hybrid, and therefore commercial office space in the long term is here to stay, is at least my view. Warehouses is also the other area that has increased because of business. There's a fungible usage between the residential assets for warehousing. Data centers is growing, especially because in the Indian context, it is digital India. So that's where we really are in all the different sectors. Of course, GST, which is a convergence of the taxes, has significantly reduced the building costs for developers, but there are obvious disadvantages which my co-panelists will also talk about on passing on the input tax credit to customers and the number of calculations that really involves, and at what point in time can you really pass that on. So it's harder to really get those credits.
Sure. Rocky, your views post-COVID about the sector and also whether GST is helping it or otherwise.
Thank you, Venkateshwaran, for having me on the panel. And just to start off on the COVID, I think things are getting better. After COVID, things are stabilizing. We're reaching all demands at the pre-COVID level on all asset classes, except office or commercial, because of still hybrid model of working from home. The demand is still not showing buoyancy. I think most of the office space vacancies also have increased. So it will still take some time for demand to stabilize on the office side of it. But residential, clearly, we've crossed the numbers as far as all the top 10 cities. We've crossed the numbers from pre-COVID as far as number of units sold. And market is also showing more consolidation as more, top tier developers are doing better. Market is getting more concentrated to the branded developers or listed developers, I should say. And smaller developers, because of a lot of compliances on all counts, RERA, GST, all of these compliances are difficult to meet the criteria. Hence, the smaller developers are giving in or doing joint developments or joint ventures with the larger developers. But just as a market after COVID has gotten back to its own pre-COVID levels now.
Okay, thanks, Rocky. So time to get little technical here, and I would want to bring Achal and Ajinkya into the fray and address the elephant in the room, right? When GST came in and substituted VAT and service tax, we all know that VAT was applicable on some value, GST was applicable on one value. There was some sense of a dual levy. GST intended to address that particular thing. Having now, we are in the 6th year of GST and there have been several changes. The question I want to pose is, which in your mind is beneficial to a home buyer? Is it we were better off under VAT and service tax, or are we better off under GST? Achal, you want to start? Probably follow by
Thanks, Ravi. Thanks. Thank you all. I think you posed a very interesting question, and it's really, I would say devil lies in details, so probably one has to work on the numbers for each project. But on an overall conceptual level, I think one can answer this in two ways. One, numerically, or the cost-wise, which one is better from a home buyer's perspective. And second, from a clarity point of view, that I've got a clarity now as a home buyer that, okay, now there is only GST of 5% and rest all, maybe, stamp duty is one thing, but other than that, whatever input side taxes, whatever taxes in the supply chain, I'm clear now that I don't need to really worried about VAT or anti-tax, LADT, all those things. For me as a home buyer, just 100 rupees as a consideration plus 5% tax matter ends without OC. With OC, even that is not there. So post OC. So on the clarity point of view, I would clearly give a thumbs up to GST. On the numeric point of view, from a cost perspective, if you really see, service tax was ranging around 4.5, 5% broadly. And VAT had, different slabs, different rates were there across the states, depending on various options available in the states. Some project owners would have taken a composition, some would have taken abatement. All those things were there. And hence an overall rate would be, again, ranging from 1%, maybe in some cases 2, 3, goes maximum to 4 or 5%. So if I club both VAT and service tax, and maybe consider the credit side as well, because even in service tax, the credit was restricted, like in GST today. I would say the overall tax cost would be coming somewhere around 6.5, 6%. And GST from that perspective is 5%. So I could clearly see a saving more on the numeric side of 1.5%. And why I'm saying so, because I've seen in many even anti-profiteering studies as well. A lot of studies were done when GST came in. Some project owners have actually passed on those benefits as well. And that benefit was again in the range of that 1.5%. Max, it has gone to 2%.
Yeah.
So probably I would say, again, on numeric side, GST is better off.
So from just to summarize, maybe I would say complexity wise, a thumbs up, and numeric wise also a thumbs up, because we don't need to deal with the multiplicity of things.
Correct.
Yeah. Ajinkya, I would like to bring you in. Any thoughts on this, your views?
Yeah, thanks, Venkat, for having me here. So while on purely, the intent of the taxation and the changes from the previous regime to GST regime, I quite allude to what Achal said, but I have slightly different take when it comes to why GST was brought into place and what were those intentions, the hollowed intentions of the parliament and the state legislature to having GST. One of the primary idea was to remove the inefficiencies from the supply chain, which is, to put simply, allow tax credits available across the chain. By way of certain changes in the law, which has happened subsequently, and also some of the changes which came with the legislation itself, I see that somewhere, so far as real estate and construction activity is concerned, the government has deliberately intended to block the input tax. That to a large extent takes away from the whole idea of GST and removing inefficiency. So that is where I see there are issues from the real estate. I say this because, look, when we talk from the perspective of home buyers, in India and I think everywhere around the world, one of the largest individual purchase that somebody makes across his life cycle is purchasing a home, which you quite alluded to your introduction.
Probably apart from marriage in the Indian context.
Absolutely. At times you get a house also alongside. So, and be that as it may. So that's one of the largest purchase one makes. And if that is kind of, parried up with number of taxes, state taxes, stamp duty, and other taxes, and then to, just pay a 5% GST, which while in pure numbers appears to be a reduced rate, but given the fact that a lot of input that or other materials that go into raw materials that go into construction activity has a higher rate of tax, and that gets embedded into the cost. I think the home buyers or introduction of GST regime has not helped the home buyers. So that is one. Secondly, internationally, what we have seen is that the governments, they have allowed, after a period of time, they have allowed availability of credit, especially where a particular real estate property or constructed building is used for commercial purpose. Now that is where I see some balancing act that the government needs to do, at least so far as subsequent commercial activities are concerned. Say for instance, I'm an advocate.
I will just hold your thought there, because we will come back to the commercial. I'll probably hold your thought, but I know that Koshal is also itching to contribute to something about it. But in summary, I were to say the packaging of GST is good, but the ingredients that go into it needs a lot of thoughts, because the inefficiencies have already been built in and not so much addressed so far as we say by the law. So Koshal, I just want to bring you in here, and on the very question of ITC, right? For be it commercial, commercial real estate is in a different sense, but let's talk about a business organization wants to set up some factory or whatever they want to do, or if even from a developer perspective, the ITC is something which is not allowed on construction. Is it a boon or a bane?
Very good question. So it's not going to give the benefit to the user, first of all, because the credit is restricted really from this perspective. And if we see the origin of this restriction restrictions come from the excise law, where the entire issue started from the discussion whether once something is getting constructed in terms of the plant and machinery, whether it's immovable or movable. And that's where the argument started that what we are constructing is immovable and that's where it should not be excisable. That is the origin from where it became inexcisible and the government forced to give this exemption or the benefit, and that's where the department started taking the view once something is not movable, one cannot claim the credit on that. But having said that, if we really see from the sector perspective today, and we see essentially what is the real objective of the GST law, then the credit should be allowed. The matter has already landed up before the highest court in India, and the hearings are on the way. So with the last hearing, we were expecting the decision, but again, the one adjournment has been sought and the new dates have been there. So probably in some point of time, we will see some clarity on these issues. But nevertheless, whether the Supreme Court gives the benefit or not, if the government intends otherwise, we may see the government making further amendments and restricting this credit. But the government objective seems to be pretty much clear, not allowing the benefit, and we are seeing a lot of litigation as of now.
So we are seems to be in a crossroads where the industry wants, and the home, as a consumer, right? We all want the most efficient tax system to be prevalent, but the government on the other side thinks to be otherwise. So there need to be some point where we need to see a meeting of minds so that it can happen. But I just wanted to get the business perspective here from Rocky, you, that these ITC restrictions, you as a person who is running a business and let's say you have a business where you want to construct something and give it out on leasing, and especially when you see that this ITC is restricted, what challenges you face in the sense from running this business point of view, or how has it affected this industry?
So, on the commercial buildings that the developer or somebody builds it for the sole purpose of leasing it, the section 17/5 has a two components to it. One is construction, one it says plant and machinery, which is furniture, fixture, and equipment. So the construction credit is blocked under the new amendment from 2019, and that also is challenged, as Koshal said, under the Safari Retreat case. It has reached the Supreme Court from the Orissa High Court, which the assessee has won in this case. And Supreme Court has not even given a stay to the department. So we have a strong feeling that even the construction services ITC will be allowed once the outcome of that Safari Retreat case comes out in Supreme Court. And then, of course, the government can come in and amend the act itself. That's a different story. But will it be retrospective? No, the act can only be amended for going forward, not retrospective. So while the section 17/5 says that you're not eligible for construction credit, and most of the people are not taking construction credit, but I strongly suggest that developers actually should take the construction credit and take that risk, because when the Supreme Court order comes in, then you won't be able to go back and take the credit. Okay, so it's a catch-22. That is one part of it. Plant and machinery, which comprises maybe 50% of your total cost in a commercial project, you're still eligible for the entire credit, and that has not been challenged. Even if the amendment which came under 17/5 subsection C in 2019, they clearly have excluded plant and machinery. So it is good. The act itself is so new. It's only 5-6 years old. It's evolving. They're issuing circulars. The litigation, I think this is the first case on GST credit matter as far as the real estate is concerned, which has reached the Supreme Court. No other dispute has reached the Supreme Court. They haven't even formed their tribunal. So you have to go to High Court for anything, and High Court is only looking at as a law perspective and not the actual merits of the act. So the act itself needs to evolve. It will take some time. But as far as your question is, if the credit is disallowed, it is only partially disallowed. That itself is disputed in the in the highest court today. And I think once even the Supreme Court judgment comes in favor of the assessee, act might change. So it is safe to say that the construction credit will be disallowed going forward. But the other half of it, which is plant and machinery, will always, the developer will be able to avail that credit. So it's not as bad as we all think. Optically, it looks that credit has been disallowed.
Okay. So, Rocky, I think my friends who are from the consulting fraternity will agree with you more, because and they would want clients like you more who are as aggressive, so that we can continue to litigate this matter. But having said that, Parveen, I just wanted to bring you in here because we as a country, as a policy level, we have been saying that we want to promote investments into the country, be it infrastructure, be it commercial, or be it even tourism sector for that matter, which all requires a lot of investment. But this specific restriction on ITC, how do you think is playing on with this Make in India and Invest in India kind of a concept?
To be a sense of
Yeah, please. Yes.
So the issue with ITC is its lack of openness. Okay. And the disadvantage is that before passing that ITC to customers, we as developers have to do all those calculations. And there are conditions in which you can claim the ITC. So given that it's made into such a complex process, what is the net result? The net result from a customer's point of view is, do we wait and watch and then make the purchase as a result of this lack of openness? And that's where it really harms industry. So while I'm saying ITC, fine, it is there, the government has decided to implement it. What can really be done so that it is streamlined, easy to understand, easy to compute, easy to calculate? That I think is really relevant. There are the sense of structural imbalances which have been created, which really need correction so that you get the input credit. I don't think anybody is averse to compliance. That can be done, but it should not be done in a manner where you make it so hard that you're really trying to defeat the purpose of claiming it.
Understood. So I think what I hear from both Rocky and Parveen is that there is this input credit is something which is good, but make the system more transparent and more clarified, more clear, so that the industry can get the benefit of it. Otherwise, what is today happening is, if there is people who are on the conservative side of the spectrum or on the aggressive side of the spectrum, end up, let's assume they don't take the credit. It increases the cost of projects in the country, which essentially means investing in India and making in India is that much more costlier, rather than if it being as seamless as where credit is allowed. So which certainly adds, say, 15-20% to the project cost for any manufacturing or even any other venture to be. At this point in time, I just wanted to bring in Gaurav. I know you have been I have not had the opportunity to interact with you earlier, but Rocky mentioned about the Supreme Court ruling, which is eagerly awaited by the industry in terms of safari retreats. What is your view from a legal standpoint of what does Orissa High Court has done in the safari retreats case, and what can be as an expectation from the Supreme Court on this matter? Gaurav?
Am I audible?
Yes, you are audible. Please proceed.
So, I mean, all of the panelists probably are more aware of GST perspective per se, because I mostly deal with real estate deals, but obviously GST is a very important factor in these. So my view with respect to the Orissa High Court judgment, so I think the Orissa High Court in this case of separated trades has essentially allowed input tax credit in respect of the inputs and input services used for the construction of immovable property, which is subsequently let out. So the judgment is a welcome judgment, and it is in sync with the overall objective of GST law, that is seamless flow of credits. Having said that, the said judgment, in my view, is going overboard with the provisions of law, and because it is a settled principle of law that the tax laws are to be interpreted strictly, and therefore, if the law does not permit input tax credit in respect of the inputs and input services, used for the construction of immovable property, whether let out or owned, then the same needs to be given due respect. The problem with such judgment is that there's a high likelihood that if it goes for appeal, I mean, when it goes for appeal, then there's a chance that Supreme Court might overrule it because it is not backed by relevant statutory provisions. So they're kind of going out of the way and predicting a statutory regime and change which might come at a later date. Maybe not conducive as of now.
Yeah. So if I were to summarize it, the ruling is futuristic, and that is what is signifying the intent of what probably is there in the industry's mind. But unfortunately, the letter of the law does not support it. And unless otherwise the government and the industry have the meeting of the minds to amend the law in a very particular manner, this is something not very great can be expected from the Supreme Court. Achal, I just wanted to bring in you here. Like today, when we are talking of 17.5, right, the wordings used are anything that is used for construction is something that is disallowed. I mean, this is a very widely worded section. And what do you think can be the implications that can arise out of this, in the sense because of the wide nature in which it is defined?
So, TRV, before I answer your question, just on the safari retreat, it was listed last week in Supreme Court itself. Unfortunately, the hearing didn't happen. So probably it will get listed further, just to give an update on that. And on your specific question, TRV, I mean, you're saying it's wide. I would say probably one can read it very narrow as well. Okay, because only thing what is restricting is that credit which is directly or indirectly linked to the construction of immovable property. So as a developer, what things I should consider? First of all, I think Koshal or Rocky, somebody alluded on that as well, that plant and machinery anyway is eligible, is out of that embargo in the law, which means as a developer, I need to first of all see what all plant and machinery is there in my construction cost. That definitely I can take credit. So that clarity has to be there. Now, what constitutes plant and machinery, that itself is a subject matter because there is a definition in the law itself, and one need to see on a case-to-case basis. So that's one aspect. The second aspect is, okay, what am I capitalizing in my books? Because that is also one of the things, that construction is only what is being capitalized. I know the overall construction, if building is there, it will be capitalized largely. But if it's a repair thing or maybe a modification, we probably, somebody may evaluate what to capitalize and what not to capitalize. Accordingly, my credit position changes on that aspect as well. So these two aspects. And the third one, which is the most important one, how I am structuring my contract for the construction. I'm typically giving it to the subcontractor on a lump sum basis, or probably can I have it separate so that at least I can identify the plant machinery, the foundation related to that, the structural support, all that, wherein I can take the credit. So if I do all that, probably I will be able to get a large amount of credit in that part. And the fourth and again important thing which is coming to my mind on this particular aspect is that what is a service which is, or a good, largely on the service part, is directly or indirectly in relation to the construction of immovable property. That aspect also needs to be evaluated for each service, probably I would say, because I've seen in some cases people have just taken, okay, for a particular project, everything is restricted. That probably may not be the correct view, because one can evaluate really that probably whether the advertisement service I have availed for that particular project is eligible, or maybe the audit related services of that is eligible, or maybe the professional services or consultant services. So these kind of services would still be eligible and will not get covered under the embargo of 17.5. So from a developer perspective, 4 or 5 things, as I said, maybe on the plant machinery, the nexus of the services, the separate contracts or the classification in the contract itself, and what am I capitalizing. This aspect needs to be seen for each and every project, I would say.
Yeah. So
I've answered.
One way to say the devil is in the detail, and it's not so simple to say no, not available. That's very easy to say, but one were to apply some mind and go into the BOQ level kind of detailing, we can always interpret it and try and see how we can maximize the buck that we can get out of the input credits. So Ajinkya, I just want to bring you in on a very important topic. Now, when we talk of real estate and construction, land cannot be far away, right? And we have a deeming provision in the law which says that wherever, irrespective of whether you have buying a home in Mumbai or in Delhi or in Nagaland or in Manipur, doesn't matter. The 1/3 deduction is what it is allowed. There was an interesting ruling of the Gujarat High Court in case of Munjal Manish Bhai, where it said that it disregarded that 1/3 restriction and said wherever the value of construction is clearly available, one should go by that. Your thoughts on this kind of ruling and also the implications, because this is something which is path-breaking, but at the same time, they stayed away from quashing that provision as well. But what do you think we can as a takeaway from the industry?
This is a very interesting question, Venkat. But before I kind of answer this question, let me just quickly weigh in on the Safari judgment and its after effects. So look, it's one thing for the High Court of Odisha to rule that credit should be available, irrespective of the fact that there is a strict bar in the legislation wherein construction activities have been completely devoid of eligibility from the credit perspective. However, I think with the 2018 Supreme Court decision in Deepak Kumar versus Union of India, where they have kind of let down the parameters under which an exemption notification or generally put, a tax legislation has to be interpreted, and what would be the scope of that legislation, which I think one of the earlier speakers did allude to. In that backdrop, I mean, it's unlikely that the Supreme Court is going to look at the Odisha High Court judgment favorably. So at the end of the day, it all boils down to what the parliament and the state legislature, and in this case, the GST council decides. I think they should allow the credit because if we have taken inspiration in the GST legislation from other countries, especially Canada, European Union, Brazil, I think we might as well adopt the credit perspective from those jurisdictions. So that is, my take on Safari judgment. Coming to the Munjal judgment of Gujarat High Court, look, it's a welcome judgment, especially because I don't think Parliament or state legislature have any business in deciding what should be the percentage of land or the value of land on which tax should not be paid. To allow deeming fiction, especially in case where there's a clear-cut availability of the information with respect to price of the land, is something going overboard. And I say this because land per se is outside the GST net constitutionally, because that is a subject area of state government. And of course, there are certain aspects of land where both union and state can legislate, stamp duty being one of them. Largely it's a state subject, and therefore states are free to legislate on that. It's outside the GST net under Schedule 2 as well as strict provisions of the GST Act. Therefore, for now, and by way of a delegated, look, Venkat, interestingly, what the government has done is by way of a delegated legislation, it has come out with a deeming fiction, which says 1/3 would be the value of land. They've issued a notification, I think 11/2017, wherein they have this, and this is what was challenged in the Gujarat High Court. So the Gujarat High Court is very right in saying that, look, you cannot do this. And given the fact that most of the metros, the price of land far exceeds 1/3 value. I mean, if I talk about Delhi, our city, or Mumbai, the price of the land would be comprising of 75 to 80%. Some of the people from the industry can weigh in on this, but that's what the case is. And therefore, to only allow part of that to be excluded from the value for the purpose of levy of GST is something which is completely, not understandable, at least now from GST perspective, and why it was brought into play. So the High Court is very right there. I think government needs to have a relook on this 1/3 disallowance. This abatement is completely not acceptable. And I would suggest that industry as a whole, they should do that demarcation of the value of land and the value of construction activities that goes into construction of a building. So have separate agreement for both. In any case, stamp duty is put on the value of land. So that makes it further clear that if a land was purchased, there's a value which is already there. So that makes it easier. So I see, Supreme Court kind of, allowing the Gujarat judgment to hold sway, and therefore the government needs to have a relook.
So I would just want to take a quick impact of this from Rocky to say, what is your thought on this 1/3 deduction? Is it something government needs to relook at, or something that is fair?
Interesting on this. I think this judgment came in. It's a little older judgment, but since 2021, or when this 1 and 5% scheme came in on GST, this kind of becomes a mute topic because you're not taking the land value into consideration as for an abatement scheme. This was in the previous GST rules when you had to take an abatement scheme as to what is the value of the land, which, I understand that the land value could be different in different states or different cities, but they had to set up a standard, a deduction, because otherwise this would just lead to so many litigations that they would go crazy. So they had this concept even during service tax regime that there would be an abatement of 1/3 for the land. So they just carried it forward during the GST regime. But now that we have a 1 and 5% scheme on residential, this becomes a mute topic because you're paying on the entire 100 rupee value and there is no abatement scheme. Now coming to commercial real estate, that's where your abatement scheme will come in. On instead of 18, you're taking a 12%.
Yeah.
To me, there your input tax credit anyways is much lower because the commercial real estate, your construction cost is a much smaller component than a residential. So there also the exchequer wanted a little higher revenue, so they have capped off at the 1/3 value of the land, which I think will have a more clarity as far as the buyer of the commercial property is concerned, because he'll understand that he has to pay 12% flat. How that 12% is derived, most of the times he doesn't know that this is an abatement scheme of 1/3 credit from the land. He thinks it's a 12% real estate GST, and that's what he is willing to pay. So I think there is more clarity now with 1, 5 and 12% on commercial, with an abatement scheme of 1/3 on the land, and 1 and 5% where no ITC is available.
Yeah. So if I were to weigh it on one side, there is fairness, and on the other side, there is certainty and ease of convenience. I know, Ajinkya, you will disagree to some extent on it.
Allow me a quick.
Yeah, I will probably come back to this. We'll park this aside for a moment because we are running short of time and we have a couple of more interesting areas to cover. I know that we may not find the right answer here, but the measure is really against what is fair and what is probably a certainty and ease of convenience, right? Somewhere we have to find the middle path. Gaurav, I just want to bring you in, and this is another touchy topic, the concept of development rights. So we know that there's again a deeming fiction where the government has presumed that development rights is something that is applicable. But if you had to go back in history, there was a Bombay High Court ruling, especially in the case of Sadodai Builders and Chedda Housing, where they said any interest that is arising out of a land is also immovable in nature. Whereas taxability of a development right, which is also some form of a right originating from the land, is also something which is immovable property in some sense, if one were to strictly apply the transfer of property rules. How do you think this taxability is something can test its scrutiny from a constitutional validity perspective, especially when this matter is before several high courts in the country? Gaurav, you're on mute. Kindly unmute, please. Yeah.
Am I audible?
Yes.
Actually, suddenly some.
Yeah, you're audible. Please proceed.
Yeah. So I agree with the views expressed by the Bombay High Court in the cases, the Sadodai Builders, Chedda Housing cases. So it's the substance of the transaction which has to be reckoned and not the form. So TDR is merely a nature of license to enter and construct, and it does not entail any supply. Now, in such a scenario, eventually it is only the undivided interest in the underlying land which gets transferred from the landowner to the buyer, eventual buyer. So, in such a scenario, if it does not entail supply, then it would be wrong to. The observation that TDR is just a benefit arising of the land and should be excluded from GST is the correct view in my opinion.
Okay. Koshal would want to bring in and take your comments on this topic as well, because this is something which we often encounter as consultants in terms of how these are structured. Your views on that?
So I think the industry is also divided, and that is a very key point, because if you see service tax law, the definition was different, where the wording used the interest in immovable property, and that's where the decision was passed in favor of the taxpayers. But if you see the GST law, they are not using the similar language or similar words, I would say, from this perspective. And here they are only using the terms immovable property. The question, substance or form, how this has to be interpreted, PC, GST committee recommendation or the fitment committee recommendation, everything from this perspective. The objective of the legislation were very clear, even in terms of the various clarifications they have come out later on, including the FAQ that they come out with at the time of 1.5%. They want to make it taxable. And the scope which was there available with the taxpayers to construe the interest arising from movable property as a sale of movable property and taking out, carving out the value from the supply, it seems to be very little gray area. Although there are the matter of petitions also required, we have to see the little light of the day whether it's really going to. I will see this. It's going to have the same treatment of safari. Even the matter is won by the taxpayer, again the government will come down its own way.
But what's very interesting in that there's a very nuanced difference in how the service tax law treated this and how the GST is treating it. Because service tax law always had a negative list where it said in a sale of immovable property as defined under Transfer of Properties Act. And that Transfer of Properties Act was very wide enough to sort of include any right that is originating from an immovable property. Whereas in GST law, in the negative list, it only says sale of land and building. And they are very restricting to sale of land and building. And that can pose a little challenge. And Achal, I just wanted to bring in and take your views on probably what can be the implication on similarly like a one-time premium that is paid on leasehold rights, right? Do you think that is also something today it is taxed as majority by the industry as renting, but do you think that is also something that can be questioned?
If I see it, there is a service element, that's for sure, right? Now, whether I paid one time or maybe on a periodic basis, that should not really determine the nature and taxability of that particular service. Yes, there have been arguments saying that, okay, it's probably a long-term lease and maybe one time we are paying, all those arguments are there. But if you really ask me, I would say as long as there is a service, we are agreeing on the service part, it is taxable.
Yeah. Ajinkya, I just wanted your simple view as a follow-up to that particular question. Today, when somebody takes on land, and this happens predominantly at industrial parks and wherever you are buying or taking leasehold rights from the government, right? Obviously, land is taken as a leasehold right, and that is treated as a service. And today, somebody constructs a building out of it. So, what about the credit eligibility of this particular tax that they pay on leasehold rights? Do you think that should be eligible, or that is something again an area of contention?
Right. So, I question the very assumption that it qualifies as service and tax should be paid. And I say this because look, GST, while it's applicable on goods and services, there are defined parameters, which all goods, which all services. There's a Schedule 3 under the GST law which clearly excludes sale of land, sale of building. And you're right when you said that it doesn't define what land means, what building means. But that's for the legislature to decide. If I look at it and I look at the constitutional scheme of things, which are the powers which are given to state to legislate upon and tax the center, and which are combined items and concurrent list, I say there is no reason why the parliament, at least given the framework of the current legislation, that is GST, tax should be levied on any land or rights emanating from that land. Parliament right now has no jurisdiction to tax those, and therefore I see Supreme Court at least weighing in on this in favor of the SSEs. That said, look, going back to the whole issue of self-supply, or if I'm using a particular constructed building for commercial purpose, credit should be allowed because it unnecessarily breaks the whole supply chain and it only pads up the tax. There's a cascading of tax which happens. It unnecessarily burdens me from doing my business in a more efficient manner. So if there is a tax at the earlier stage, and there has to be a tax on the output supply, I don't mind paying tax on subsequent sale of constructed building which I have used. Say, for instance, a lot of jurisdictions, they levy GST on second sale of home or sale of used houses. The only reason they do it is because they tax on the first stage, they allow you to take the credit. And that is an efficient way of doing or taxing a particular transaction. But at least in our constitutional scheme of things, land, building is something which is a no-go area. Therefore, and I did not see the 101 constitutional amendment that took place in 2017 to kind of bring completely land and building within the purview of GST legislation. That being the case, I would hold my thoughts on this.
Yeah, sure. So, Rocky and Parveen, I know JDAs and presumptive taxation of development rights is a touchy topic for any developer. they sort of tried to sidestep that issue in terms of housing by saying it is exempted on the hands of the developer as long as it is sold, etc. But when it comes to commercial, it still remains to be a very touchy point. How do you navigate these commercial discussions in terms of what impact it really does, especially the taxation of the development rights?
I think largely it applies to how the deal gets structured. That's where the impact really comes. And in a deal, it can structure it even in so many different ways due to the relationship between the landowner and the developer. So whether it's really a transfer of the development rights or it's construction services, or you're going to develop certain area and give that to the landowner as a consideration. So that's where really it was, and of course the GST impact related to it. But I think corporate consultants, it's great because that's where we really have to maximize, because the viability of the project, and I know of certain projects where because of these issues, we've lost some project value. And this whole business case which really gets made out because of GST issues. The impact can be so high. And beyond the point, it's really difficult to structure the deal. And that's where the deal, really drops. So great location, everything seems great, but then it is just not valued from a tax perspective. It's that
Structuring becomes a challenge. Rocky, your thoughts, please.
So I'll split that into two. One is residential, one is commercial. So residential is absolutely tax neutral because now they put it under RCM. At the time of a completion of the project on the unsold inventory, you are obligated to pay the the TDR on the GST on the portion of the units of the UDS of the undivided share of the land of the unsold units only. In fact, that brings more clarity, and this will put some rest to a lot of litigations that are going on because of this clarity. The litigations were that is this a TDR, is this not a TDR? Now that there is law is settled that this is TDR, this is a service, and it's only supposed to be on the unsold inventory. That makes it very clear, because in the olden days, if you would have taken a credit of ITC and this was before the 1% and 5% scheme, you would have to reverse it at the OC, at the occupation certificate. You would have to reverse the unsold inventories, taken credit. So it is absolutely tax neutral on as far as residential is concerned. Nobody should have any complaint about it. In fact, there is more clarity on it. Now coming to the commercial side of it, you have to now consider this as TDR. You have to pay GST. And you are eligible for the input tax credit for the same GST that you're paying on it. And nobody should complain about it. Why? Because you're paying 12% GST as an output service, which your input is much lower in the when you're doing commercial, because your construction cost, you typically on a commercial, your land cost is much higher than 30% because you're doing at a prime location. So your land cost will exceed 50 to 60% of the total top line. So even if you paid on a JDA, the TDR, GST on the TDR, you would be eligible for the 100% of the credit, and you will not end up with an inverted input tax credit structure. I've done the math on so many projects, and the input GST that you will pay for as an input, you will be 100% eligible for credit as when you're generating the output of it. So it becomes a tax.
Just a slight catch there. The reason being that if you're into leasing after construction, that is where the challenge arises, where the credit is denied.
Yes. So credit is, again, that's a gray area, because credit is denied on the construction of the building, not on the TDR, not on the plant and machinery. TDR is not mentioned anywhere.
That's an interesting point that you bring in. Anyway, I think, as I said, I think we are little running out of time. But before I open the panel for questions from Sapna, each of you, your wish list for this sector from the government. What would you like? Is everything is fine, or something if it has to change? What exactly has to change? I'll go in an alphabetical order. Achal, with you.
Okay, I think that will be the wish list for everyone. Credit where at least I'm paying on the output side, whether in the lease rental or commercial, whatever. Credit should be allowed, because that's
credit should be allowed on wherever I'm paying on the output side. Great.
And
Ajinkya. Sorry, one chance.
Of course, I think Parveen did mention about it. The setting of GST tribunals to reduce the litigation. I think that's where
true. That's true.
Lot of
Ajinkya.
So quite second what Achal said in terms of credit being allowed in case there's a GST output. My wish list would be to to completely remove the land cost from the overall value of the supply on which tax is levied, because GST cannot be levied on any value of land. Right now, even if there's a 5% tax, implicit in the value is the value of land, and that needs to be excluded.
Yeah, sure. Gaurav? I don't know whether Gaurav is able to hear us, but Koshal, your wish list.
1 in 5% should be optional, not mandatory.
Sorry, can you please repeat that? I was a little...
Yeah, the option of 1 or 5% on residential properties should be optional and not the mandatory.
Yeah, great. Rocky?
I totally concur with Koshal that 1 and 5% scheme should be optional. SSC should have the right to either opt for a non-ITC scheme or an ITC scheme, which is what they did in 2019 when they notified
Correct.
1 and 5 scheme. They gave an option that it's an ongoing project. If you follow certain criteria, then you could go with the ITC scheme. I think that should be a normal business, because this will solve a lot of problems.
Gaurav?
Yeah. So one issue which I think which probably need to be addressed is just with respect to home buyers. So what we face a number of times is that the GST is able and paid at the time of payment and at the time of and many times payments are done at phases, etc. And at the in many cases, ultimately they do not make the final payment. If the allotment gets cancelled or things change, so then it becomes a problem getting the refund and all those things. Even though I think 3 months back they have got a circular where they have facilitated even GST refunds for people without having GST numbers, but the issue is that it is still a major problem, and especially
Problem for refunds.
For refund, correct.
Yeah.
So I think maybe the timing. So what happens is that maybe they should change the timing to the time of registration, which is probably the time when things will get crystallized, and you will definitely know that this is the property which will go to this person. So I think this is a practical thing which probably needs to be.
This is what VAT had done. VAT was
Yes,
at the
exactly.
time of registration.
Exactly.
Yeah.
Parveen, your final thoughts. One wish list.
Just agreeing with Koshal and Rocky, and just keeping it simple.
Okay.
Hello.
So what I hear is that, of course, credit has been a major proportion, which is causing a lot of heartburns. On one way to look at what the intention in which GST was brought in, it was basically to make it a very efficient structure. Now with only being 5% or 1% being charged, while on optically it looks it's a very low tax. But one way to look at, let's say 60 to 70% is materials, and an average rate of 12 to 15% on GST on those materials gets subsumed. 30% with 18% GST gets subsumed. So we are looking at an effective tax cost, which is already ingrained to the extent of around 14 to 15%. Add to that a 5%, then we are looking at a 20% cost on owning a home. And if you add to that stamp duty, it's ranging from 5 to 8%, close to 28% to 30% is going in taxes just by paying a home. So certainly it's not making the life of user very efficient. It is not an efficient structure, so to say. So maybe government has to think about it, and forums like these and people part of the industry should raise their voice in terms of making it a more efficient structure. With this, I thank all of you. But before we close, maybe Sapna, if you have any few questions we can take, and then we can close this.
Yes, definitely. It was good to hear the wish list of the experts here. And we'll go to the wish list that has been expressed by the audience also. But before that, we have one question here that should facilities such as parking, clubhouse, sports facilities, etc., be clubbed with the value of the property, or should be separately charged as a facility? How should that be?
Achal, you want to take that question?
I would say it will be a composite supply wherever at least, if depending on the overall nature of the transaction, if it's a land sales or maybe a plot sales, not even land, plot sale, then probably it should be composite. If it's a flat sale, then according to the tax treatment should be there.
It's already, there is a circular, it's called club service now. It's clarified.
Yeah.
Okay, so parking and all, everything becomes part of the land GST, and the club services.
Depending on the tax treatment of the
Yeah.
depending on the tax treatment of the overall transaction.
Okay, I think that makes it clear for our audience. Another question is that, would lowering the GST, like what Venkat also mentioned, that it will be a big boost to the industry if the GST can be reduced, because overall it becomes a very big tax component. So from our experts, should GST be reduced if we are looking at home buyers, boosting the home buyer sentiments?
I think Rocky and others alluded to this fact that this 1% versus 5% should be made optional. And the moment I think when that happens, efficiencies can set in, and that itself can reduce the number of at least the tax costs that we may want to include in this. Ajinkya, I want to add to that. Any thoughts?
And about the construction materials as well.
Yes.
That's a question.
Quite agree with that. No.
Cement, I think, should be brought to 18% instead of 28%. That's one big burning point that industry has been saying time and again. And the government has also promised us that this will be brought back to 18% slab. I think that will happen sooner or later.
Okay, so that's a positive note. And Venkat, would you like to add something to what all our speakers have said as a summary, closing the session?
Yeah, I think I fairly said, I think I agree with all my friends here in terms of making this a more effective and an efficient tax structure is the need of the hour. I think we cannot keep on arguing about the technicalities, the merits of it, etc. But if a true sense of GST has to be achieved, we should not just go by ease of convenience or what it is. It should be fair as well. And when I say fair, the entire ecosystem, like for example, cement, like Rocky, you mentioned, I don't know why it is considered at 28%. It is such a primary requirement for any development to happen. And when and you're saying 28% is for sin goods, how come cement is a sin good? It is an essential commodity. So I think a whole gamut of this rate structure is something has to be relooked at, leaving aside the revenue implications of it. Because once the taxes become more efficient, I think it will have a multiplier effect, and it will have a boost to the economy, and that will also improve consumption. So that is, I think, is a primary need of the hour. The promise of GST was that it will be a efficient tax structure. We are far from it, as the discussions that we had prove that. So I think the effort of the industry has been to take its voice to the government and make them understand the transactional realities and try to make it more efficient. That would be
right.
my
That's
closing
right.
comment.
And that's the entire effort here that we are trying to do. But as our experts say, rationalization of slabs is something which is required in GST. GST as a whole is not a bad concept. And still we are working on it. It's only been 6 years now. So let's, with positivity and looking forward to some, better developments happening. Let me thank all our panel members here, Mr. Venkat for that wonderful moderation, Mr. Koshal Agarwal, Achal Chawla, Ajinkya for joining us, Mr. Rocky Israni, and Gaurav for being here with us for this discussion. Thank you so much for that informative, sharing those informative views and for taking those audience questions. Thank you so much.
Thank you so much. It was a pleasure.
Thank you.
Thanks, everyone.
Thank
Thanks
you.
for being such a great panelist.
Thank you, everybody.